If you're earning income from a side hustle, even small amounts, understanding IRS reporting requirements is critical. The IRS is intensifying enforcement on side hustle income, and avoiding common mistakes can prevent triggering an audit or receiving a notice. First, let's define what qualifies as side hustle income in plain terms. It's any money earned outside of a normal W-2 paycheck. Common examples include rideshare driving for Uber or Lyft, delivery services like DoorDash or Instacart, selling items on eBay, Etsy, Facebook Marketplace, or Amazon, freelancing work such as design, editing, coding, marketing, or consulting, social media income from platforms like YouTube or TikTok, affiliate income, sponsorships, and cash jobs paid through Venmo, PayPal, or Zelle. Here's the critical part many people miss. It doesn't matter if the work was part-time, occasional, seasonal, or just for fun as a hobby. If you received income in exchange for a product or service, the IRS expects that to be reported on your tax return. Why is the IRS cracking down so hard right now, even on small amounts? Simply put, because they can. Technology has made it possible. Platforms track transactions, marketplaces track sales, payment processors create records, and banks track deposits. The IRS identifies who to audit using a matching strategy. Understanding how this works is essential to avoid becoming a target. The IRS compares what you report on your tax return against what third parties report to them about you. When those numbers don't match, a computer flags it. This is an automated system that notices mismatches between what you report and what others report about you. The number one trap is thinking that side hustle income is too small to matter. Many people assume that if they didn't make much money from their side hustle, the IRS won't care. Let's clarify this. In previous years, if you made some money and didn't report it to the IRS and nothing happened, it's not because the amount was small. You didn't get an IRS letter because the IRS didn't see it and didn't know about it. But if they see your income, the size won't protect you. Here's an example. Suppose you made $2,200 from a side hustle, and the payer sends you a 1099. Your tax return shows 0 because you didn't report it. The mismatch is clean and obvious, and that's what triggers an IRS letter. Even if you made $2,200 and your expenses were greater than that, meaning you had 0 profits and 0 taxable income, all the IRS sees is that you received $2,200. They don't see your expenses. They'll try to get you to pay taxes on that gross amount when in reality, you shouldn't. It's best to report it properly and record the proper amount of expenses rather than getting an IRS letter and being put through an unnecessary audit. Mistake number 2, waiting around for a 1099 tax form that never appears and thinking you don't have to report it. That's not how it works. Here's the rule. You must report your income, whether or not you receive a tax form. If you don't get a tax form, that doesn't magically erase the income. A common mistake is when the 1099 tax form was sent but got lost in the mail, or the taxpayer didn't realize they had to download it. They thought that because they didn't receive a copy, that income was never reported to the IRS. Saying, "I never received the copy of the 1099 won't work with the IRS. They won't care if there was a mailing problem or a communication problem. The IRS will say you should have known about it. It's your responsibility to report it correctly. That defense won't work. Mistake number 3. People working in the cash economy think their cash payments and cash apps are invisible to the government. Honestly, if we're talking about cash payments, it's more difficult to be on the IRS radar. But in practice, if you get cash, most people make deposits, payments, or transfers with that cash. If you're ever audited, your paper trail will be obvious to an IRS agent, and patterns matter. If you get paid in cash and make a deposit of cash every week, or have consistent payments through apps, the IRS will question it. If you can't explain it with your records, you'll be in trouble. Mistake number 4, mixing personal and business money. If you receive an IRS letter, this mistake will cause chaos. If you run your side hustle through your personal bank accounts, you create a documentation nightmare. Your side hustle income and your personal transfers and transactions all get mixed together. You won't be able to easily prove what was related to your side hustle as a business deduction and what was personal. Your legitimate business expenses can be overlooked and forgotten because they're all mixed up. You'll either overpay taxes because you forgot to claim real expenses or underpay taxes because you're guessing. The fix is simple: separate accounts. At a minimum, use a separate checking account or a separate credit card for your expenses related to your side hustle. This avoids an accounting nightmare. What actually triggers IRS attention? The IRS often gets involved because of mismatches and patterns. Common situations include when a third party reported income to you and your tax return doesn't have matching amounts. That's a mismatch that catches their attention. Large deposits that don't fit your reported income will get you flagged. Huge expenses with tiny revenue from your side hustle will get you flagged. Sudden swings, like one year with big income and the next year dropping to close to nothing, will be picked up. Multiple platforms reporting activity while you report minimal amounts or zero will be detected. How is this possible? The IRS system is automated. Their software analyzes oddities. If your tax return looks suspicious, the computerized system triggers an IRS letter. If everything's automated and running through computers, it's not a labor-intensive process for the IRS, nor is it expensive. That's why they're capable of sending millions of IRS letters to Americans, even if their suspicions revolve around smaller amounts in question. If you want to stay out of trouble, here's a simple approach. Track your side hustle income independently. Don't rely on the 1099 at year-end. A spreadsheet is fine. You don't need fancy software. Separate your side hustle money from your personal money to avoid an accounting nightmare at the end of a year. Keep basic records: invoices, receipts, platform statements. These serve as your documentation and proof. Don't wait around for your 1099 forms. Track everything independently and treat those forms as confirmation, not as the source. Don't guess your expenses. Document them and keep them organized. Set aside money for taxes as you go. This isn't about fear. It's about staying organized so you're in control. The people who get hit the hardest are those who are disorganized and those who say they'll deal with it later. Handling this on a quarterly basis is much better than saving all the accounting and bookkeeping work for the end of the year, which can become a nightmare, especially if you're mixing personal and business-related expenses. Let's bust a few myths. Myth number 1. If it's on a Cash App, it's not income. False. Income is income. It doesn't matter how you received it, cash, check, or cash application. If it's income, and it will be reported. Myth number 2. If you didn't get a tax form, it's optional to report that income. Not true. Just because it's not on a form or you didn't get the form doesn't mean you don't have to report it. Myth number 3. If you're not an LLC, it's not a business. False. The structure doesn't decide taxability. If you don't have a formal business entity like an LLC, it doesn't matter. If you got income, it's income, and you're operating as a sole proprietorship. That's how they see it and classify it. Myth number 4. If it's a hobby, you can ignore the income. Not in the eyes of the IRS. Income is income, whether it's a hobby or not. Here's a real-life example. Suppose you have a side hustle where you receive $6,000 in income and get a tax form. You have $4,000 of legitimate expenses related to the production of that income. Your taxable income would be $2,000. Your profits. You'd have to pay taxes on that $2,000 of profit, which comes out to something like maybe $500 in taxes. If you don't report it, you're setting yourself up for an IRS notice. the IRS will demand that you pay taxes on the full $6,000, which comes out to something like $1,500 in taxes. That's because they don't see your related business expenses that brought down your total profits. You'll have to go through the trouble of proving your expenses to bring down your tax liability from that estimated $1,500 down to $500. That's going to be very stressful. It will take months. It's not a short process. It will be lingering in the back of your mind for all that time. And you may even want to hire an accountant to help, which takes time and money. It's a terrible situation to avoid. These days, side hustles are more common than ever. The IRS has been adapting to this modern economy where income is easier to see and match. The bottom line is that the IRS wants their money. If you put yourself in a position for them to come after you, they will, and they'll additionally impose penalties. Avoid these mistakes. Don't assume it's too small to matter, because the IRS will try to get every penny they can. Don't wait for tax forms. Don't treat cash apps like invisibility cloaks. Don't mix personal and business money. Don't guess expenses. And don't wait until April to get serious about this.